We're back with part 3 of our video lecture series for chapter 4. We're going to continue with Roth IRAs and traditional IRAs. That's a topic later in chapter 4, and we'll save that for another video. Let's continue with a type of savings. We're saving tax efficiently here for education using an account called Coverdell. And there's a second type that's probably preferred to Coverdell called a Section 529. 529 is the Internal Revenue Code section, the law that covers this type of savings for education. Let's also take a look at another type of savings account that will help take care of disabled, probably dependents. Here, the acronym is called ABLE. Let's see, achieving a better life experience. So let me diagram for you how these saving type accounts work. So I did mention there was a Roth type that we'll cover in another video, a Roth individual retirement arrangement or account. And then we'll have another type of IRA called traditional. Whenever you hear the term IRA without Roth or traditional in front of it, you can assume it's going to be a traditional IRA. If it's a Roth type, it will mention the word Roth. And then another type of savings account we'll see just real briefly. I'll mention it here though. It's called a health savings account. You're saving for future medical costs. And then there's that ABLE type account we just saw for disabled beneficiaries. And then the two educational accounts, the Coverdell and what I think is the better of the two, the Section 529 type of account. Okay, so here's our taxpayer, and they want to save tax efficiently for future costs. So they can save by putting money into a Roth IRA or traditional. Here we're saving for future health costs or for a disabled person and maybe for future education. When you put money into one of these accounts, we call that term contributions. And for most of these contributions, when you put the money in, there is no tax benefit, immediate tax benefit. There is no so-called tax deduction, except in the case of a traditional IRA. Possibly we would take a deduction for the amount contributed, deduction on our tax return. It may also be that contribution is non-deductible, ND. In fact, that's how we figured out. Well, let me just finish this slide here. Putting money into a Roth IRA, non-deductible. Putting money into a health savings account is deductible. I'm going to maybe talk a little bit here about the health savings account because it's not really common in Hawaii. To be able to have a health savings account, the taxpayer also has to have what we call a high deductible health insurance policy. And for most taxpayers, they get covered with their employer's health plan. And here in Hawaii, I believe it cannot be a high deductible plan. Or other taxpayers are covered by Medicare or Medicaid, and they wouldn't qualify for health savings accounts. If you can qualify, it is a good tax benefit. But again, most people in Hawaii don't qualify. Here you can see what they do get upfront is a deduction to help them reduce their taxes. If you put money into a ABLE account, there's no immediate deduction, non-deductible. Same thing with a Coverdell, non-deductible, and also for the 529. No deduction when you put the money in. So why would you do that? Why would you use these accounts? The benefit is when the money comes out. Yeah, when you're taking distributions, yeah, withdrawals, and you're paying off certain types of qualifying costs. Again, the term we use when you take money out is called distributions. And they have to usually meet certain conditions. In the case of the Roth distribution, this should be tax-free, assuming again you're meeting certain conditions. In the case of the traditional IRA distribution, we saw back in chapter 3, we may have to go through a formula to figure out how much is taxable and how much is tax-free. Okay, so I won't go through that formula. I don't even remember it. I have to go back and look at it if I had to do the calculation. That was in chapter 3. When you take money out for the health savings account, assuming you're paying off qualifying costs, that should be tax-free. For ABLE, taking money out, assuming qualifying costs for the disabled person should be tax-free. Here you're paying qualifying education costs, tax-free. Tax-free here, yeah? Now, over the years, you're putting money in, you're contributing. And the money is not staying static. It's being invested, probably in some type of brokerage account. So it's increasing in value over the years, more than what you put in. Now you have more to take out, more to distribute. So let's kind of talk about, well, these two, again, are for retirement purposes, yeah? And we'll focus on that in a separate video. Again, you're putting money here into a health savings account that's not common in Hawaii, and then you have to take it off only for health purposes, qualifying health costs. Again, you're getting a deduction up front here. So for the ABLE, typically maybe it's a parent trying to save money for a disabled dependent. You can probably do that all the way up to the age of 26 for that covered person. And I believe there's a maximum annual contribution of was either 15 or 16,000 per year. Again, it's increasing in value. And when you're making distributions for that disabled person, probably it's for education, probably it's for welfare, probably it's for health of that disabled person. So now here are the two educational savings account. In the case of the Coverdell, the maximum contribution per year for each student, each dependent, each person you're covering is $2,000. In the case of the 529, there is no limit, so it could be real big amount. Typically, you try to stay under, let's say, 15,000, so you don't have to file what we call a gift tax return, not an income tax return, but a gift tax return. And there's no income limit on the donor's part. They could be a multimillionaire or very poor. But again, in the case of the Coverdell has an income limit. I offhand can't remember the dollar amount, but it's 100-something thousand. If you go over that, the 2,000 maximum contribution starts to phase out. So you're taking money out now when you are ready to pay for usually higher education costs. But within the past few years, the law has changed to allow taxpayers to withdraw up to $10,000 per student for their lifetime to pay off elementary, middle school, and high school private school costs. Again, the intention typically was to pay for higher education costs. Another exception for higher education is you can use $10,000 out of this account to pay off student loans. Otherwise, the intention is for qualifying higher education costs, which includes tuition. Okay, you're paying this out now. Tuition, fees, textbooks, supplies, maybe computer equipment, even room and board. All of these are qualifying education costs. Although you have to reduce the qualifying costs by any tax-free scholarships and grants, reducing the amount of costs that's qualifying, reducing the amount you can take out tax-free. Now, if for some reason you take out more during the year, out of these accounts than the qualifying education costs you have. The excess may be taxable, but what's taxable is only the earnings. If you remember, we put in non-deductible contributions into these accounts. They should come out tax-free no matter what, if you pay for education costs or not. It's the earnings, the increasing in value over the years. That's the part that could be taxable if you're not paying for qualifying education costs. Let's take a look at the tax form that reports distributions from the educational account. Educational accounts, again, that's the 529, or here's the Coverdale number, yeah, the 530. This form is called 1099Q, again, either for a Coverdale. Here's another name for the 529, Qualified Tuition Program. And here's the total amount taken out during the year. And if you have this same amount in qualifying education costs for the year, then none of the distribution is taxable. But the distribution is made up of two parts. The amount that the taxpayer had contributed, that's called basis here, and here's the increase in value over the years until you've taken out the money. So these two here, the basis and the earnings, should equal the total paid out during the year. So let's say that of this total gross distribution, you didn't use all of it for qualifying education costs. Let's say only half of it was used. So this half that was not used for education costs may be subject to income tax. In fact, really this half that's not used is half of the earnings and half of the basis. And what's taxable, if anything, is the earnings part. Okay, so not the total distribution that wasn't used for education. It's just the earnings part you got to figure out. So this is the amount that's subject to income tax. But they're not going to let you go with just paying income tax on that. They're going to penalize you. So in addition to reporting that earnings part as income tax, there's going to be a 10% penalty on that earnings. Again, you still may have money in the account, but we're only looking at what was distributed during the year and comparing that to the qualifying education costs for the year. Again, qualifying education costs, tuition, fees, books, supplies, maybe computer equipment. Okay. Let's see where this 10% penalty is calculated. On Form 5329 has lots of different penalties. So the one we're looking at, this is one we'll talk about later on when you take out money too early from a retirement account. But we're taking out money from an education account or even an ABLE account. Again, that's for the disabled person that was not used for qualifying costs. So here's the amount taken out during the year. Here's the amount that was used for qualifying costs during the year. And here's the amount that wasn't used for qualifying costs for the year. We multiply that by 10%, and that's the additional tax, the penalty. In addition to the income tax you got to pay on this line number 7. In fact, let's take a look at some others. If you put too much money here, excess contribution into retirement accounts, you may be penalized. That's for both traditional and Roth that we'll talk about later. Here is money you put too much into the educational account. Again, remember that $2,000 per year limit for Coverdell? Or if you go over the income limit for that donor. Medical savings account over contributions. Health savings account we just talked about also. Yeah, you put too much money in. All of these are usually 6% if you have excess contributions. And then also ABLE, again, there's a dollar limit. I think it's $16,000 per year. And you got to stop when the beneficiary is age 26. Yeah, otherwise you possibly made an over contribution, penalized at 6%. Here's a penalty that's just the opposite. you didn't take out money when you're supposed to from your retirement account. The law has recently changed where from retirement accounts, not counting the Roth type, when you reach age 72, you're required to take out a certain minimum amount, required minimum distribution. And if you don't, you get penalized on 50% of what you should have taken out. Pretty stiff penalty. So typically, if for whatever reason this had occurred, you try to get the penalty abated for some reasonable cause by writing up a message to the IRS. Okay, so that's this form 5329, you know, to calculate out the penalty. Okay, again, most times we're taking distributions out tax free. Again, the term we use here in chapter 4 is excludable. Let's talk about one more type of excludable income here in chapter 4. Let's move down to something called cancel or discharge of debt or money you borrow. So typically, let's say you have a bank that lends money to a borrower. Yeah, so here's the money going to the borrower. And the borrower never pays back the money, either because, well, they just don't have the money, right? And if the borrower is bankrupt, possibly that forgiveness of debt is tax free. If the borrower is not bankrupt, or what we call solvent, they have lots of assets compared to liabilities they owe, that canceled debt is taxable. Common types of debt would be credit cards, auto loans, personal loans. So typically, if it's an auto loan, they will repossess the automobile. But the big one would be a home mortgage. Yeah. Let's take a look at the form if the debt is canceled by the lender. This form 1099-C. And here is the amount of the debt that was canceled. In other words, the lender says, I give up, I cannot collect. And whoever this person borrowed the money now has to report it as income on their tax return, unless they're in bankruptcy, legal bankruptcy, and only to the extent they owe more total liabilities compared to the value of what they own. Again, that we call that insolvency. But once this debt is forgiven, and if it makes the borrower solvent, meaning they owe less now than what they own, to that extent of solvency, the loan is going to be taxable. Okay. Now, again, the big debt possibly could be a home mortgage that's forgiven. If that's the case, the lender's probably going to foreclose on that property and sell it to pay off this loan that was owed. Let's take a look at the form here. It's called a 1099-A. So here's the amount of the loan that should have been paid off. Here's the value of the property, probably that was foreclosed on and sold to pay off the loan. So if that's the case, you would take the value of this property and you minus out the costs the taxpayer paid for that property. And the difference would either be a gain that's generally taxable or a loss that may be deductible. But if this was the taxpayer's home, this gain may be excludable. We'll learn in chapter 10 or 11 at the end of this semester, when you sell your principal residence, if you meet certain conditions, any gain up to 250,000 for one person or for a married couple, half a million, the gain is excludable. If this property is your personal residence and you sold it for a loss, the loss is not deductible. If for some reason when they sell this property and it still doesn't pay off the loan, the excess loan you still owe. And again, if the bank cannot collect it, that is a loan that is canceled, you know, and possibly taxable. But for the past decade, since the last big recession, the law says up to $1 or $2 million of unpaid mortgage debt on the canceled mortgage of the home uh, is tax free. And they've been renewing this exemption, this exclusion for, again, the past decade in increments of usually 2 years. So currently, this 2 million or $1 million tax-free exclusion of home mortgage loan goes through, I believe, 2020. There's more forms to fill out if that's the situation, yeah? Um, but let's stop here. When we continue, we'll talk about the two IRA topics here in this chapter.